What if Trump's economic moves aren't just about tariffs or bringing back manufacturing? What if they're part of a deeper strategy, one that reshapes how the world trades, borrows, and competes? It's already underway, and the architect isn't who you think. Behind the scenes is Stephen Miran, a quiet economist inside the White House, pushing a vision to realign the global economy. They're calling it the Mar-a-Lago Accord, the invisible hand inside the White House, the man behind Trump's tariffs. If you like this kind of deep dive content, where we unpack the global money moves behind the headlines, hit like, subscribe, and leave a comment. It helps us know what you want more of, and it helps more people discover what really matters. In 1944, the U.S. anchored the global financial system at Bretton Woods. Currencies pegged to the U.S. dollar. The dollar pegged to gold. The world gained stability. The U.S. gained dominance. By 1971, America couldn't afford to keep the gold promise. Rising inflation from the Vietnam War and expansive domestic spending had flooded the world with dollars. But the U.S. didn't have enough gold to back them all. Foreign governments, especially France, began demanding gold in exchange for their dollars, and the U.S. risked running out. Nixon ended the convertibility. The dollar became fiat, backed by trust, not metal. But the world kept using it, for trade, oil, and global finance. By the mid-1980s, the U.S. dollar had soared in value, up more than 40% in just a few years. It was making American exports uncompetitive, worsening trade deficits, and threatening domestic manufacturing. Inflation was under control, but growth was slowing. Something had to give. In 1985, the US and four major economies, Japan, West Germany, France, and the UK, signed the Plaza Accord. Their goal? Coordinate efforts to weaken the dollar through policy alignment and direct market intervention. It worked. The dollar fell sharply, but so did the yen's stability. Japan's currency surged, flooding its economy with cheap capital. That led to massive asset bubbles in stocks and real estate. And when they burst, Japan entered a deep economic slump. A lost decade of stagnation and deflation. China today mirrors Japan pre-Plaza. Export-led growth, high savings and investment, real estate bubbles, demographic headwinds, but China differs. Middle income status, managed currency, capital controls, global supply chain integration. One-party state. If forced to revalue like Japan, the shock could be larger and more global. Stephen Miran is Trump's top economic advisor. His plan? A quiet realignment, the Mar-a-Lago Accord. Weaken the dollar, push allies to hold long-term treasuries with lower interest, use trade and security as leverage, charge access to the dollar system. It's not a formal deal. It's a strategy in motion. If countries go along, U.S. gains, exports rise, debt stabilizes, leverage grows. Allies get market access, currency strength, but face asset bubbles and policy dependence. It's Japan's story, retold. If countries resist, they diversify away from the dollar, strengthen regional blocs, face currency volatility. And the U.S. risks higher rates, diplomatic pushback, and fragmented markets. So who can stir the pot? India can. It's uniquely positioned, friendly with the U.S., active in BRICS, and one of the biggest beneficiaries of supply chain diversification. It can align temporarily with either camp, but fully committing to one would shift global momentum. A tilt toward the U.S. would isolate China. A pivot toward BRICS would strengthen alternatives to the dollar. Russia already is. It's accelerating de-dollarization, selling energy in yuan and rupees, and actively promoting a multipolar financial system. With sanctions locking it out of the Western system, Moscow has nothing to lose, and every incentive to pull others into its orbit. Together, India and Russia represent the swing boat and the spoiler. One can build new bridges. The other is burning the old ones. Both are shaping a world that doesn't revolve around Washington. The wildcard? Saudi Arabia. For decades, Saudi Arabia has been the cornerstone of the petrodollar system, pricing oil in US dollars and recycling the proceeds into American assets. That quiet agreement has helped maintain global demand for the dollar. But things are changing. Saudi Arabia is building deeper economic ties with China, exploring yuan-denominated oil sales, and seeking to diversify its global influence. It's hedging, balancing between Washington and Beijing. At the same time, the kingdom is central to any vision of global energy stability, making it a kingmaker in both financial and geopolitical terms. Trump's upcoming visit to the Middle East is more than symbolic. The U.S. is approving $3.5 billion in arms, supporting $600 billion in Saudi investment, considering easing AI chip exports to allies. Washington is trying to re-anchor Riyadh, using weapons, money, and technology. If Saudi Arabia shifts away from the dollar, the entire global financial architecture could be shaken. That's why it's not just a partner, it's the wild card. And if you're curious about Saudi Arabia's growing role in tech and AI, don't miss why the Middle East might win the AI race, and no one's noticing. Link in description. The dollar is still dominant, but if allies feel squeezed or excluded, they will look elsewhere. Miran's plan walks a fine line: regain control without triggering a global reset. The Mar-a-Lago Accord isn't signed. It's not even official, but it's real, and the person behind it might be the invisible hand inside the White House. If you want more videos that connect the dots between markets, politics, and power, hit like, subscribe, and leave a comment. And if you want to understand why the US government needs to do all this, check out our video, The Truth About US Debt, Tariffs, and the Future of the Dollar. Link in description.